We're live. Hi,
All right.
Amir. Welcome. I know, right? Like every time, even I'm doing this every day, but I still feel like every time when I'm like live, I'm like, oh, I'm live. But anyway, welcome to Venture with Grace today.
Thanks, Grace, for having me. I'm glad to be here.
So let's start off the show by I would love for the audience to get to know you a little bit more. You started your career in tech, and how did you get into an insure tech or fintech investing?
Sure. It has been a long journey, I feel. Sometimes I forgot how many steps I had to take to get here. But so let me start from the beginning. So I actually grew up in Germany for most of my life. Believe it or not, I speak fluent German. Sometimes people think I work for the CIA, but I don't. But because I was born in Iran and my parents moved to Germany when I was 5 years old. And so I spent the majority of my obviously childhood and time in Germany, my undergrad in Germany in computer science, and then spent time right off the bat, mostly on the entrepreneurial side, on the operating side. So I was part of an enterprise startup or software startup in Germany where we built business communication management software that we sold to larger companies for use cases like complaint management, sales management, and so on and so forth. So that was a great experience, and right after an undergrad, and the company was eventually acquired by Actuate here in San Mateo, which is now part of OpenText, a bigger conglomerate. And then I ventured out into the consumer side. I was always fascinated by the consumer side. So back in the days, a friend of mine, we both got together, kind of set up an e-commerce shop for furniture. That was when, I don't even know when it was, like 15 years ago. I think we were a little bit early, but we kind of missed the market a little bit, kind of focused on perfection rather than execution. But I think there was a lot of learning there as well. And then I made my way to the US. I've been in the US now for almost 11 years, believe it or not. The time flies. And I came to the US to get my MBA. I was at Georgetown. And while most of the people I know go to get an MBA, their goal is to get into consulting or investment banking or like a bigger brand kind of corporation. My goal was to, spend time in the tech scene and figure out a way to be involved more on the tech side. And I was fortunate enough to really right off the bat work on the venture side. So that's how I actually got into fintech, because my first endeavors in venture capital were with a fund out of DC, Arlington, and Route 66 Ventures, which is kind of like a small family office kind of venture capital type. And they were very early on in the fintech and insurance world. They were one of the first and seed investors, for example, in Ripple, the company, not the coin. And when they brought me on board, my first deal was an InsurTech deal. And I have no background in insurance. My background is in tech and technology, software. And so I was like, this is weird. What is insurance, man? Like, I don't understand. So it took me a little bit of time to figure out what they're doing. But then I, quickly figured like, hey, this is a pretty interesting space. And, I stick with it. I was there for a year and, made my way to San Francisco 9 years ago. Time flies. And I was fortunate enough here to get into a venture capital fund that was just formed, Munich Re Ventures, which is the largest reinsurance company out of Germany. Set up a corporate venture farm up here, and I was part of like kind of the initial founding team. I was number 3 on the team. We had one fund under management when I joined, and we're part of this bigger conglomerate investing in anything related to insurance and fintech or financial services. And I was there for 6 years almost. And, I got the itch to go back to early stage investing. And I was fortunate to get the opportunity to join Aviate Ventures, where I'm now a general partner here and lead the fintech and insurance practice. So it has been a journey. I hope that kind of, it gets into the details to how I got to where I am today.
Totally. I wanted to so like for the audience who may not be familiar with like AVA Ventures, why don't we talk about like, how is it formed? And I know that you guys have association with Allianz and I wonder if you're comfortable like sharing a little bit more about like the background of the fund and how how it is related to the LP itself.
Yeah, of course. So the fund started in 2018 by my partner George, who was, brought on board to kind of set up this fund. We are, as you mentioned, backed by Allianz. However, we're not a corporate VC, right? We don't have a strategic mandate here. The mandate literally is to, invest in up and coming technology companies in different sectors, one of which is the fintech or insurance world. The others that we focus on are healthcare and healthcare services. We do a lot on the enterprise side, which is anything related to anything software from AI to infrastructure and so on and so forth. And then we also dabble a little bit into deep tech. We are set up as a typical venture firm. We're 4 partners. We have an associate, we have an operating partner, we have 2 venture partners, we have a lot of venture advisors. And the decision making and anything that takes place is within the firm, within the 4 partners, and each of us kind of like focuses on different categories or sectors. And I lead the fintech practice here. However, nevertheless, with any venture firm, we also have conversations with our LP, right? So we have quarterly or depending on time. Couple times a year conversations with the LP. However, I always also tell founders we're not here to really make introductions, because that's the difference here between AV8 Ventures and the firm I was before with Munich Re Ventures. When we started, it was kind of a corporate venture firm where we needed to have some sort of a business buy-in to make investments, which obviously is good, but also makes it challenging if you want to invest in very early stage startups. And from AVA's perspective, we are now on our second fund, over 180, with a similar size first fund. We mostly focus on early stage startups. I would say that the sweet spot is seed. We have done pre-seed, we do pre-seed, and we have done also Series A investments. Typical check size is anywhere from $1 to $2 million. However, I've done 500,000 and I've done also $4 million. So we're pretty flexible there, but we like to stick to our guns and, most of the time be first or second institutional check-in. From my perspective, I've joined like almost 3 years ago, 2.5 years ago, almost 9 deals now. Most of the deals I've either led or co-led. I'm very conviction driven in terms of the investment perspective, and want to be have a skin in the game. I'll take most of the time board seats. I think I'm board member on 8 of the companies, and try to be very hands-on with the entrepreneurs, to bring in my expertise both from the startup world that I learned in Europe back in the days, and the investing side over the last 10 years, and obviously the whole landscape of insurance and insurtech that I witnessed over the last 10 years as well.
I wonder since you have been investing in the insurtech space for many years, I wonder, can you give us a little bit of background on how it flows? So I guess for the audience, when they're thinking about insurance, they think about Geico, they think about State Farm, they think about maybe Lemonade. That's the most insurtech company that assuming people think about. And I wonder, in the entire industry, how does the money flow? And can you share a bit more about where does the tech component typically come from, and why it is why it is going to be a profitable business in general?
Absolutely. Okay. So let's start from scratch to how we got, I think, to the word insurtech first, right? I think that would be maybe sets the tone here. And I mean, I recently also started writing 2 years ago. I was like, hey, maybe I should start putting my thoughts to notes and better understand for myself what my thoughts are and where maybe the future of insurance is. So I started, my first piece was the last 100 years in insurance. And the reason I did that is because I wanted to understand where did we start and where does insurance come from and how did insurance evolve and how did we got to like InsurTech and why have people focused on, investing in InsurTech. And you mentioned a couple of names, Geico and State Farm. I mean, these guys are like the incumbent behemoths that, started in the 1920s. And then, in the 70s and 80s, we had a first wave of like technology enablement on the insurance side where, you were able to have, price comparison websites and so on and so forth. And then within the 2000s and 2010s, the first wave of these InsurTech started. They were more focused on distribution, and some risk taking. And I think, the phrase InsurTech, was formed around 2014 and 15, where the whole notion of investing in InsurTech started with the names you mentioned as Lemonade as one of the earlier InsurTechs that was focused on home and renters insurance, and then we had a bunch of others that focused on similar product categories. I think when it comes down to how this industry works, I mean, it's one of the largest industries when you think about insurance. And I always tell people, InsurTech sounds maybe not so quote unquote sexy, but at the end of the day, anything you do on the personal or, either business side touches insurance one way or the other, right? I mean, you're now sitting in your home, you have home insurance, you drive your car, you have car insurance. If you have a business, you have business insurance. And there's all sorts of other things that people don't even, are aware of. So insurance is a big part of society. However, technology has been, a little bit of the back burner on the insurance side, but it's not that, the incumbents have been sleeping, right? I think, from how the incumbents have been set up, given that they started in the 1920s and 30s, technology was not ubiquitous like it is today, right? It was not that anything that we have today was given there. So the foundational level of these companies might not be so much tech enabled as these InsurTechs. So the notion of InsurTech started with like, hey, these incumbents basically, they don't really quote unquote care about the customer. They basically classify customers as policyholders. There is, little to no interaction with your insurance carrier. If you have a claim, if you have the question, it's really hard to get to, hold of them. And so the notion of InsurTech started of like, hey, let's build digital enabled InsurTechs that are technology first, right? And enable the customer to, talk with us 24/7, enable them to get a quote in like seconds or minutes compared to like maybe a day, and so on and so forth. However, I think what we learned over the last like 10 years is that, insurance is not a top line business, it's a bottom line business. So when you look at these companies like Lemonade, Hippo, and Root and others, and I have tremendous respect for the founders and the companies that they have built. I think the focus, unfortunately, and it's all learnings, right? The focus was on growth for the past 10 years because we were just in the area of, zero interest rates, high valuations, money was abundant. And so the focus was on growth. And when you think about insurance or fintech in general, any product, a financial product that you offer, or any consumer product that you offer to a consumer that has a market price of, let's say, $100, and you come around and be like, I give it to you for 50, you can be sure that you will get a lot of customers, right? And I'm just making these numbers up, but I think the focus was on growth, and these companies showed like a very tremendous growth trajectory. However, the underlying metrics when it comes down to profitability were not given, right? And so when you look at those companies right now, I think some of them went public. Some of them have been successful to navigate the waters of the public market. However, I think what they did for the industry, which I think is more tremendous, is that they kind of had a wake-up call for the insurance industry of like, hey, technology should be part of this ecosystem, and how can we go and implement technology in insurance? But first of all, think about insurance metrics, Because going back to what you asked in terms of like how the money flows, right? I mean, the industry is kind of composed of like carriers, which take the risk. Then there's the reinsurance side, which basically insures the carriers, right? And so like the insurance is someone like Munich Re, Berkshire Hathaway, Swiss Re. These are like kind of like the reinsurance carriers. Then you have the carriers, which are the Geicos, the State Farms, and so on and so forth. And then you have the agents and brokers who basically work with the customers, right? And then you have like the digital interfaces, like price comparison websites and so on and so forth. So from the money flow perspective, you have the consumer or the business on one side. Then traditionally you had agents and brokers that a consumer or a business would talk to with the need for insurance, and these agents and brokers would represent you with the carriers and find you the best quote, the best price, or whatever it might be. And then the risk would go from left to right and right to left, right? And so InsurTech kind of got here in the middle to basically be like, hey, we don't need this middle stack anymore, the agents and brokers. We can just enable everything with technology. So you can tell me what you want and I can give you a price because I work directly with a carrier. I think that was one of the notions of InsurTech over the last 10 years, that these agents or brokers will become obsolete. But I think the learning there is that, at least from my perspective, I think also from the industry perspective, agents and brokers are here to stay. The question is, how can you enable them to, do their business more effectively, efficiently?
I wonder, you mentioned like, so for there is like the Berkshire Hathaway and other like financial institutions. Are they the so you mentioned like a couple keywords, right? Like one it's like the carrier is like Geico or these like big quote unquote insurance firms, and then there's like the insurance reassuring carrier. So those are the big like financial firms. I guess, like, how does that work? So the reassure carrier is going to be providing the insurance, aka the money, to insure things. Is that how it works? Or like, I guess, like, how does the
Yeah.
math work in this case? So I'm always fascinated by the entire insurance ecosystem, because I also read like your article. You have like 3 parts article about the opportunities in insurtech, but I just wanted to make sure I understand it correctly. Um, so essentially, how it works is, let's say 100 people shop for an insurance product, and then maybe just one or two, like from a percentage wise, people actually got into an accident or like needing the insurance, right? So because of so many people chipped in, and like only one or two people need to take it out, so there's like a basically you can make money that way. Is that how it works? Or am I like just like I don't want to be so
No,
simplified?
that's part of it. So let's start with this. So when you think about yourself, or you have, let's say, home insurance or auto insurance, right? The way it works is that you pay a price, which is the premium. It's called premium that you pay for your policy, and that premium goes to to the carrier. And the calculation for the carrier is always, part of that premium. They always, associate with any losses you might have. And that goes back to how risky you are as a customer, right? And so for a carrier, it's very important to create a risk pool with a diversified, risk. How do you say, like, risk? Yeah, diversified risk pool, right? So they want to have maybe someone like you. They want to have maybe someone like me. They might decline someone that doesn't fit their risk, right? So they create this risk pool where everybody pays in the premium, and how actually carriers make money is actually not through most of them actually don't make so much money from the premium or from the premium they got. They actually make the money from investing that premium into fixed income and other sorts of assets, right? The
Oh,
premium
okay.
is called
Okay.
float, right? And obviously they have to have reserves for, like, when losses happen and so on and so forth, right? So when you think about a Geico, they get, I don't know how many policies they have for cars, but I think it's in the tens of thousands. So all of that premium comes every month in, and obviously the holy grail is obviously to have no claims, but unfortunately or fortunately it doesn't work. So you always have claims. So they have some, obviously money set aside. I just, set aside to play out these claims. But then the reinsurance side comes into play when, there is catastrophic losses, right? So think about now, it's a great example. A lot of these carriers have actually pulled out of different states in terms of providing insurance, right? Because they had so many losses over the last year related to natural catastrophes, and so on and so forth, that they basically lost more money that they earned, right? And that's where also reinsurance kicks in, because they basically insure the carrier, right? And the reinsurance is a very difficult and different topic, which probably takes more time that we have here, of how that works. But there's also a circulation of money between the carrier and the reinsurance carrier, right? But in general, you can think about it like you pay a premium, and then there is a middleman, which is an agent and broker, or it could be like this digital insurtechs. They take a cut of that premium, right? Then the rest of it goes back to the carrier. That carrier basically uses that money and invests in fixed income and other sorts of stuff. And hopefully over time, the risk calculation they made and the risk pool that they created allows them to basically have more money than they lose. It's a very simple, explanation here. But at the holy grail for a carrier, the holy number is called the combined ratio. The combined ratio, if the combined ratio is over 1 or over 100%, it means that the carrier is losing money. And if the combined ratio is below 100%, that means the carrier is actually making money on every dollar premium that they get in, right?
Wow. Okay, so one of the things in your article you mentioned, thank you so much, by the way. This is like making a lot more sense than what I was like going through my head while I was reading this. So I wonder, so one of the things that you mentioned in your article, I'm sorry, I took some notes. I wanted to make
Sure.
sure I found them. So like one of the things that you mentioned is okay, let's just start with this one. Like, so basically you mentioned like there is for the insurance, like the innovations are coming from this is like on the broader side, there's like new products, there's underwriting, there is distribution, and you use example of like Wax Insurance, Cover Tree, Blue Zone, and Reframe. I wonder for like overall, what are some like something that you feel like technology could fundamentally change how InsurTech work? Like what is InsurTech in general? Because you mentioned like the agents are and brokers are not going away. From because I previously when I was working in investing, my background like so our firm looked into like property tech, and the basically I got the sense of like the broker of all these like basically your real estate agents are not going away too. So I wonder why are these industries so sticky with human related component, because I think for property related things I could understand because the ticket is very high, right? Like you really want the human touch of before buying your biggest purchase in your life, which is your home. But as for insurance, like since we are technically I know that you said this in another podcast is like, if you're like if you spend like $130 per month on an insurance, you're not gonna easily switch to $121 plan, right? So I wonder why the human component is so important in the insurance space, and I assume that's where the amount of money is gonna spend on.
Yeah.
Right? So yeah.
Yes. So I think going back to like, the last 10 years of InsurTech and how does this wave started, when you look at the companies that were created, most of them focused on, the traditional commoditized businesses, right? Home, auto renters, pet insurance. And I think that was the I don't want to say easy, but the easy way in to build, an InsurTech, because, the products were understandable, they were commoditized, and it was easy to build tech around it and basically be like, hey, you don't need an agent or broker anymore to buy auto insurance, but you can buy it on your app and I can give it to you within like minutes, right? And you're right. I mean, those policies are usually very small, right? It's $100 a month, maybe $200 a month, maybe $300 a month. So you shouldn't be really needing someone to advise you on that. However, I think the broader notion is that usually someone, a traditional person, doesn't only have one insurance product, right? You have a home, you have an auto, maybe you have a pet, then you have some life insurance. So that's, I think, where the notion of the agents came into, was like, hey, I'm going to cover all your needs instead of one. So if you have multiple products, you don't have to go to multiple different insurtechs, right? And as you can see with Lemonade, which is quite interesting, and that's the case with most carriers. Most of them don't have just one product, because it's really, really hard to build a profitable business just on one product, right? Most of them have a diversified portfolio of different products, as evident also what Lemonade has been doing over time. They started in like renters, I think, or home, and then went into, bought Metromile to do car. I think they partner up with another insurtech to provide pet insurance, and so on and so forth, right? So it's a diversified pool there. And in terms of, where from my perspective, tech comes into play here, and why, the first wave of insurtech had a harder time to, show amazing outcomes on the public market, is when you think about insurance, as I mentioned before, such as auto, home, and renters, these are like commoditized products. They have been around for years. It's a very saturated market as well. There's very few people that come to market every month or every year that need new home insurance or new car insurance, right? So it's basically, everybody has some sort of a coverage. So what happens there is that basically you're just fighting about price, right? So, and technically, when you think about insurance, you don't want those people who go shop around, because those are the worst risks you want to take. So, and it's easy, as I mentioned before, to scale this up quickly. And it's the same for fintech too, right? If you offer something for a lower price, people will take it, right? It depends just how much lower it is, and that way you can, show the growth. However, the learnings from the first wave were that, technology is not necessarily going to help you win insurance. I think the first thing you have to focus on is the insurance world. And as far as I'm concerned, is my question is always, in general, from the investing perspective, and you have been an investor yourself as well, is like, what is the problem you're solving? And let's go back to the first principles approach, right? And when you think about the first principles approach and the first wave of insurtechs, you quickly come to the conclusion that, the problem was not as big as people thought, right? Insurance was not really broken, right? Geico, State Farm, and whatever, they had enough technology, or they had enough, they had built enough for you to be able to get insurance. It might have not been in like 1 minute or 5, but you were able to go on their website to, fill out maybe some form. Someone would get back to you. You have a phone call. You would get insurance somehow. And I think when you think about the first principles approach, claiming that technology will solve that problem, it's hard to say that, it did, right? It definitely made it easier from the consumer perspective, more slick and more nice, and whatever you want to call it. But now going to the next wave of insurtech, the focus is on, like, at least from my perspective, on a couple of things. One is on niche insurance markets, right? And niche insurance markets, as you mentioned, I invested in a company, Covertree, which focuses on manufactured houses in Middle America, right? And you will probably say, like, well, it's a house, but why is it different than a traditional house? Well, homes that are manufactured manufactured homes have a different class of business, so the insurance is different there. It kind of falls in the specialty lines of business. And there, when you look at the market, there are two big players in the market which kind of dominate the market, and others, and the market in general is very fragmented. However, none of these players really have a digital product. Everything is still most of the time paper based, right? As someone who lives in a manufactured home, you have to fill out a PDF. You have to talk to an agent. That agent sends in the PDF, and so it's very cumbersome process. So if you can bring in technology into that process and enable the agent to do his or her work more effectively and efficiently, and at the same time enable the consumer to buy insurance in a streamlined approach, that makes sense because you're merging two worlds, right? And there is literally a problem because the other problem in that market too is that a lot of these homeowners or the people who live in those homes are underinsured as well, because given that the process is so cumbersome, some actually don't go out and to get insurance, right? And so there's a lot of underinsurance in the market. So when you think about these things from an investment perspective, it makes sense to invest in an insurtech that is tackling that problem, because you're not fighting with incumbents, right? You're not fighting with a commoditized product that has taken over the market, and it's not really a price fight there too. Sure, people will have relationships with their agents, and it will be hard to convince them to take on another product. But that's why the approach that CoverTree is taking here is that we enable independent agents to write quicker and smarter, but we also are focused also on other channels. So when you go and want to buy a manufactured home, we're kind of incorporate in the lending aspect as well to provide you insurance right off the bat. So it's not really a D2C approach here as well. And so that's one part when you think about these niche markets. That was just one of them. And then the other aspect where technology, I think, comes in and makes sense is, as mentioned, the enablement of the agents and brokers, right? Because how can you provide technology to these people to enable them to either write more business or write business more effectively and efficiently, right? Because most of the time, from the broker or agent perspective, is on prospecting, is on quote generation, wait time to get quotes back from the carrier, and so on and so forth. And if you can build infrastructure there that can help expedite the process, it makes sense. One of my recent investments, it hasn't been announced yet, however, I'm happy to talk about it. They are focused exactly in that space, which is they're enabling carriers on one side that want to write risk, right, and have APIs but don't have distribution, and then they have on the other side the agents and agencies who are able to distribute the risk to consumers but don't have the connection to the carrier. So they have built a kind of middle layer function here to connect these both worlds and enable them to work together, right? It sounds very trivial, right? And it sounds very easy. However, it's not as easy as you think. And I think that's where the focus of InsurTech is going these days, because and I've said this before, and I think firmly believe into that. When you think about venture, right, and all of the big outcomes that by now, I mean, the Amazons, the Googles, the Facebooks, the Ubers, and so on and so forth, all of these have been really $100 billion of businesses, right? I don't think it is really possible to build $100 billion InsurTech, not in the short and midterm, right? Because again, if you look at the incumbents that started, I don't know, 100 years ago, a Geico or a State Farm, I don't have the real numbers in front of me right now, but they are valued at like $40 to $50 billion, like in terms of market cap. But also their book of business, the premium volume that they have is almost a similar amount, right? So for an insurtech that takes risks and write risks to get there, it will take a long time, because unfortunately or fortunately, insurance is a get rich slowly business, because you don't want to take on as many risks as you can. You want to be selective in risk taking and be very careful in that sense.
I wonder when you're thinking about, so for example, when we like, so you talked like briefly about like the opportunity, that the CoverTree opportunity, which is they are focusing on one specific area, like literally geographic area, and because of this geographic area and the policy of the insurance is like very differentiated than like a traditional, what the big name insurance people can offer. So that's like one specific thing. And then I wonder, when you're thinking about the profit center of InsurTech, like there's two components, sounds like. One component is like they are selling a product to the mass audience, and then the more people buy, the more likely will be you will have more money into your investing arm. The investing arm will invest the insurance money into different financial products. So I wonder, as an insurance company, are those two majorly their like employees distributed, like, the frontline salespeople, the agents, and you know typically, I guess, like the sales arm, and then on the other hand there is the investing people on the investing arm. And the so I also saw that you wrote about like the insurance tech 1.0, and then now it's like 2.0. I don't know if now it's still in the 2.0 era, but I wonder, so basically you're saying technology is not necessarily like the main issue or like main like differentiation of this sector. um I wonder what are, I guess, like how, like for the companies, for like the smaller startups to go in, like I guess, like what do you think would be, for example, let's using like Lemonade as an example, because this is like a, as you mentioned, like this is like a one of the insurance company that have done the whole bracket of things, like they bought a company focusing on, like, so originally they started with home and now they have car, pets, and a bunch of other stuff, assuming. So when they're entering the space, they are technically using technology for the disruption, and it's a lot cheaper than the past. I wonder, how can they be a lot cheaper? Is that just because of the agents are replaced by technology? And for them, why are they successfully executed out of many other insurtech company? What would be the challenges to enter into the ecosystem? I know that you chat about like the insurtech 1.0, like the market's like large and like saturated. And like, can we just chat about like where would you say would be the opportunity window, and how would be like a, I guess, like what are something that still can be done, because Lemonade already exists, and then number one, like why are they successfully done so in terms of like entering the mainstream market quickly and replacing some of the past solution, and then what are other things that the current insurance 2.0 people could do to kind of like dominate whatever they are doing in
Yeah.
their app sector.
Okay, let me level set that a little bit here. So in terms of like you asked, like maybe again where the money comes, or when money flows, and how actually expenses and losses come together. So the way you can increase your profit as a carrier, or as someone who distributes a product, is either you are better in distribution, which falls into the expense side, better in distribution and underwriting, because you can better predict who is a better risk, and you have a better access to the market, and you can get those customers quicker, better, faster, whatever it might be. So that's the expense side. And then there's a loss side too, where again you are able to understand different risk categories. So if you can manage these sides well, you basically are making money, right? Because you're basically going to the market and be like, well, Grace, I think, is a great risk profile. She's going to pay us $100 for in perpetuity, hopefully, because you're going to stay with the carrier. You're not going to change. And hopefully she will never have a claim. We'll make like, a lot of money there. However, it's very hard to find only those customers that only make money, right? I mean, knock on wood, I don't have it here, but I have a car. I've been having this car for the last almost 2 years. I pay around $140 in premium every month, or 150. And obviously, so far, I had no claims. So you can think of, the carrier obviously makes money with me, but then they have, others who are maybe, they thought they were not risky, but at the end of the day, they had a claim, so they have to pay out the claim. So that's where the balance comes from, right? And I think when you think about InsurTech Wave 1, when they came in, the notion was like, hey, again, we don't need the agents, which is part of the expense side, because we don't need them to distribute. We go just direct to consumer, right, and tell them how fast and quick we are, because we have this slick underwriting platform that quickly gives you a quote in a minute, and that way we can eliminate some of the expenses. But I think people quickly realize that direct to consumer is still expensive, right? So CAC and LTV didn't line up, and then on top of that, you created a book of business that is not profitable, and then you have like this wheel going on where you spent a lot of money acquiring customers, and like you trying to offset the losses with the book you have built. And so coming to the question of like where I think technology makes sense, or where we can focus on, again, from the first principles approach, my question is always to InsurTech is like, what problem are you solving? Because most of the problems that InsurTech wave one companies solved were mostly distribution problems, right? Be like, hey, you don't need the agents. I can give you this quote. You can just go on your phone and like you can have a quote in 5 minutes. But that was just part of the equation, because going back to what I said before, there was not really a problem in the market, because you could have gotten that policy from the incumbent maybe in 20 minutes or like 5 hours, right? So that was basically where technology came in, of like, hey, I give it to you in 1 minute and you don't need that, and we're going to remove this expense. But from the first principles approach, again, the question is always like, what is the problem you're solving? And I can give you another example of an InsurTech that I've backed that might be even easier to understand there. I've invested in a carrier, a full stack carrier that is operating in the Latin American market, right? And when you think about the Latin American market, the insurance penetration there is like 3% of the population, right? And there are several reasons why the penetration is so low. One is obviously the financial stability of the population, financial means of the population. Second is the incumbents, in terms of how they work and the products that they offer, and so on and so forth. So here the notion was like, okay, this is an under-penetrated market. However, it's growing significantly year over year, right? They have like, I think life insurance is at 12% CAGR in Latin America. It's one of the most profitable, actually, continents in terms of insurance as well. There is no digital product out in the market. People still have to go to these agents, and if they want something, they have to fill out the paper form. So it makes it very cumbersome for someone to get insurance. And I think that's a huge part of where I think technology makes sense, is that we have a growing middle class in Latin America who is seeking financial stability the same way you and I are seeking it as well, right? And so if you bring all of this together and create a platform that enables agents to sell insurance more effectively and efficiently, which the company I invested in is doing, which is called Ole Life, then you basically are really solving a problem in a market that is growing and where you're not really competing with incumbents, if that makes sense, right? Because the way that Ole works is that they have created this obviously a full stack approach to underwriting. They have underwriting in house. They take the risk in house, and work with different sorts of. There's some sort of an echo. Is it me? I don't know. There was just an echo. They work with leading reinsurance carriers together, and they have this broad network of the largest agents and brokers in Latin America that they work with, where they provide the platform to those people and enable them to write more policies, if that makes sense.
I wonder, when you mentioned about like write more policies. So basically, for insurance, typically people will be like, oh, if you have X amount of like maybe let's say like if you have a car and then it's a car insurance, you have this car valued at X amount of dollar, and then if you insure with us X a month, and then you will be able to get Y amount of like money back if something happened, right? So that's like kind of and then like they have different policies, like, oh, if you invest, like not invest, but if you spend like $100 you got X, and if you spend $200 you got Y. So those are called different type of policies assuming, and then they have just like a full menu of like different offerings from financially. It will like make sense for them, as well as it will be like, different like offering for the customer. And I wonder, in terms of like you mentioned, like full stack, meaning so the company have to invent these type of policies, and then they have to have a sales team, and then they have to have like a financial backend engine. So like, do they work with like a typical, I don't know, big Latin bank, or like how does it work from like the backend?
No, with full stack, I mean that they basically own the whole process. And you think about insurance value chain, from like product creation to
Yeah.
marketing, sales, to underwriting, to servicing, right? That's kind of like the typical value chain. And they basically created the product together with the reinsurance carrier that they work with, right? So they have vast amount of data over the last 10 years that they collected to create and analyze and underwrite different sorts of the population. And then from the distribution side, they work with like the leading agencies, right, that they have onboarded. And then from the customer servicing side, given that they sell life insurance, they have it in-house as well. So there's no bank involved here. I think from the financial side, if you are a carrier, you need some sort of a solvency ratio, meaning you have some sort of a capacity capital that you have on the balance sheet to be covered in the case of claims, because again, at the end of the day, you want to avoid the claim, but you never know what's going to happen. I don't know, there might be an earthquake in some sort of a region where they have insured a bunch of people in that region, and all of these people die. They have to cover those losses, right? I don't know if that makes sense from where full stack comes into play, because most of the insurtechs that were created in the first wave of insurance were not really full stack. Lemonade actually was a full stack, because they went into the market, were like, hey, we want to actually be a new digital carrier, right? We don't want to rely on other carriers. We want to be a digital carriers. Others started as so-called MGAs, and MGAs are kind of the middleman there as well. They work together with the carrier, right? And they can create a new product with the carrier, but they're not the risk-bearing entity. And most of the insurtechs actually started like this. The one I mentioned, Covertree, is actually an MGA. They are working together with the leading carrier that actually takes the risk, right? But they are responsible for distribution and servicing and so on and so forth.
I'm taking notes. I wonder if, as for this whole industry, like for example, for a Covertree comparison with the Latam insurer company, I wonder what would be more like, I guess, like as for Covertree, I think you mentioned about like they are in charge of like distribution and everything. What will be their like unfair advantage? And then also, it just sounds like, for using like an AI comparison, maybe there's people building the foundational models, and then there's people building the GPT wrappers. I would consider like the Covertree is more towards like the application / wrapper side, and then the full stack one is more towards like, let's start building like a foundational model or something, that kind of thing. So I wonder, they both seems like have different advantages. I guess, like, what would you consider would be like the biggest risk to invest in this sector? Like, for example, in, let's say, for example, if you're only in charge of like the distribution, what if the big incumbent backend company, they decided to like create their own GPT wrapper? Or like, on the other hand, if like the full stack sounds like it's just going to be very capital intensive, how is the financial side of things like kind of
Yeah,
justified in the process?
yeah, 100%. Yeah, so I think you can draw lines here similar to fintechs, to the fintech side. When you think about these neobanks when they started, right? Think about the neobanks. They couldn't do it by themselves. They had to have a license from a bank, right?
Right.
And think about it the same way here on the insurtech side. Covertree cannot do it by themselves to start with. They had to have some sort of a agreement or capacity agreement with a carrier to write that risk. However, what the unfair advantage for CoverTree is in that place is that they have unfair advantage in terms of distribution because they have secured different kind of distribution channels and have unique relationships with those distribution channels. So as an example, they have one channel is an independent agent channel, which they have established. The other one is that they work with lenders that provide, financing for those homes. And the third one, which I think is even the more exciting one, is that they have partnered up with the communities where these manufactured homes are placed in, right?
Mhm.
So these communities, manage like hundred thousands of these homes. And if you partner up with them, you have an unfair advantage in terms of distribution, right? And I always have this discussion also with my team because I feel like the notion in the market or with a lot of people with insurance is that we're looking for the holy grail of like, hey, this is the holy grail. It can't be replicable, and this is it, and But I always tell people like I don't think that the holy grail exists, right? Because we're operating in such a regulated market, similar to fintech. I mean, think about it. On the fintech side, it's the same. I don't think that there is a company who is the holy grail. Maybe it's Stripe, right? I mean, they have been really, really successful, but they had also go through like the hoops of like figuring it out. So here again, also from the Latin American startup Ole, the unfair advantage there is different. It's two-sided. One is that they have created a new life insurance product which hasn't been in the market yet, right? That's the first digital life insurance product. That's first the unfair advantage. But with that, you cannot buy anything, right? I mean, probably you and I, we're smart enough. We have connections. We can figure it out and build a product. However, that's not going to secure you anything. And so that coupled with the distribution channels that they have partnered up with the 12 largest agencies in Latin America as distribution, right? If you bring those two together, it will be really hard to to beat that because it's about everything. I feel like in technology, and a lot of people might disagree. From my perspective, you can replicate, right? You can go and build a new Uber. Like the question for me is always like time, money, and effort, right? Does it make sense to do that? So I think for these insurtechs to be successful, you have to have some sort of an edge. That means you either have, a new product in the market. But again, not any new product makes sense because you have to also think about the market side. Like, is this really needed? Is there a product? Just because it's digital doesn't mean it's better, right? And then obviously on the distribution side, if you have an unfair advantage there too, that makes a lot of sense. And then I think third, both of them, and most of insurtechs do, they over time have such a machine going in terms of like underwriting that they are really hopefully over time able to, underwrite better and take on better risk. And so if you bring those three together, I think that's where you can really build a successful insurtech.
Mm. I wonder for InsurTech investors, I want to jump out like the whole industry talk for a little bit. I
Sure.
wanted to learn more about like what's your content that look like or what's your inspiration behind like what to invest. Obviously, I like read the article about like, there is a McKinsey article about the LATAM and that you have referenced in your article, as well as like you have referenced some of the most like active insurer venture arms, including AXA, Mass Mutual, American Family, all that. So I wonder, from investor perspective, where do you get inspirations from, like, what would be like a good, where basically where the market is going, and then is there any giant trends that you are seeing in the market that, like, um in the insurtech space that you are paying a lot of attention to?
Yeah, I'm very, opportunistic when it comes down to the insurance side. However, I have some, thoughts around what I'm interested in, right? So, um, I think given that, when you look at again at InsurTech Wave One, and all of these companies have tremendously uh, put in a lot of effort and try were very successful in terms of what they built. However, once some of them exited and went public, the notion was a little bit different. And so a lot of investors actually exited the InsurTech side because they're like, hey, it's not profitable, it's really hard to scale. And so a lot of like insurance investors or InsurTech investors that I know were like, hey, we're not going to touch insurance again because they got a little bit burned, right? And it goes back to everything we talked about before, because at the end of the day, it should have been obvious from the get-go, but I think everybody, was looking at the positive side, again, given that, money was abundant, zero interest rate environment, and so on and so forth. And I don't think just InsurTech got burned. I think a lot of other companies in other sectors got burned during that time too, because it just raised too much money without really producing any meaningful, profitable revenue. So the question is, where is this industry going? I think the notion in the market is that people are very much focused now on the other side of the tech, which is the enablement tech, basically technology that enables either the carrier side or the agents and brokers, and less so on the new product and challenger side that want to challenge the carrier, right? However, I think from my perspective, I still am very much interested in those risk-taking new product generation companies, because, and all the bets I've made are all in either new products or in markets where a digital product can have an unfair advantage, right? And I think that's the way I look at it. So I was just talking to a company yesterday, or two companies yesterday. One is in the so-called surety bond space. It's a very different kind of market, but they're also, what they have built is kind of like a digital underwriting platform to enable those surety bond players to be able to underwrite more effectively, efficiently. The question there is also in terms of market size. But I think the other notion in the market too is obviously anything around AI. And I feel like this is like a topic that has been going on for the last couple of months, a year. But I think we have to level set there a little bit and differentiate between reality and expectations when it comes down to financial services and insurance, right? A lot of people might think that, AI will solve all insurance problems and, large language models and so on and so forth. But at the end of the day, AI has been around for the past, 50, 60 years, right? Decades. And people have been using AI and playing around with AI. I think what is different now, and kudos to the incumbents and actually also OpenAI, who were actually at the forefront. ChatGPT kind of like changed the trajectory, because it made it available to the public, right? And I think that's where this notion comes from of like, oh wow, yeah, like, if everybody can use it, we can create this significant outcomes. However, I think we have to be realistic, because a lot of people think just because there is ChatGPT and now generative AI and large language models and so on and so forth, we will be able to cure cancer by letting our laptop run in idle mode overnight. I don't think that's that's going to happen, and I don't think that's going to happen also on the insurance side. There's certain aspects when it comes down to insurance, going back to the value chain, from product development to underwriting to servicing, where the AI component makes a lot of sense, and can again enable the different players in the market. The question just from the venture side for me is, with the companies I'm talking to that are building these technologies and selling into the carriers and selling into the ecosystem, is how fast you can scale and how big can you get, right? Because with any SaaS product out there, specifically those selling into regulated markets like financial services and insurance, it's very tough, and it's a very long sales cycle. And very few have been successful so far. However, I think there is a lot of opportunity because the industry needs the underlying technology.
Okay, on that note, I have a 1-minute fire round for you before we end the conversation. First question, what's your favorite book?
One of the books I read and that always like sticks with me, it's called the Medicus, which is translated into the physician. It's by I forgot always what who the I have to look it up, who the author was. But basically, it's about a young kid who travels through Middle East to be a doctor and goes through various stages of his life, and it's very fascinating.
Mm. That sounds like an interesting book. And what's your content diet look like in your sector?
My what day?
Content diet. So what do you consume to inform yourself in the InsurTech and
Oh
fintech
yeah.
space?
My content consumption is I have actually like a Google alert that basically has two words, which is insurance and insurtech. So I get basically everything coming out in the news on a daily basis. But I think in general, I really like to listen to other people. So I listen to a lot of podcasts myself, and not only in insurance, but in the broader financial services space and the technology space. I think these are like the two kind of things that I focus on. And again, like as you mentioned, I've written 3 pieces so far. My goal is to write 10, and I'm working. The fourth one is already ready, and the fifth one I'm actually working on right now. And there, I pick a topic where I think, as an example, like how the evolving role of AI in insurance and insurtech. And then I get into the weeds to talk to people, read about AI. How does AI actually work? Where did AI actually come from? What is the history of AI? Why is it now so prominent? And how can it be useful in insurance? And I think I use different mediums to educate myself.
Mm. Who made the biggest impact in your career?
I think it's hard to pinpoint it to one person, but I think there was a lot of people down the road who enabled me to get where I am today. However, I think one I have to mention, obviously, back in the days in Germany, the startup I worked with, the people over there, but also coming to the US as the first kind of as an immigrant, knowing nobody. I literally had 2 suitcases and had to figure out my way out. And I was giving a chance to work in venture right off the bat with the firm I mentioned. I think that kind of set off the tone for me to get to where I am today.
Who would you invite to your dinner party?
Oof. Again, I think it's hard to pinpoint it to one person, but I would be fascinated to obviously talk to Albert Einstein, and I think that he would be one of them. Then I just had a chance actually to be part of a private speech that Peter Thiel gave around technology and society last weekend, which was quite fascinating. Have time to spend with him alone would be great as well.
Where can we find you outside of work?
Well, on social media, obviously Twitter and LinkedIn, I'm pretty active there. But outside of the whole tech ecosystem and whatever, I spend a lot of time in the gym, try to be healthy, but also spend a lot of time with my wife and our dog. We go on walks here, and we try to explore new restaurants as much as possible.
Okay, last question. What insurance are you on?
That's a good question. My car insurance is Progressive, actually, believe it or not, and my home insurance is Lemonade.
Amazing. Awesome. Amir, thank you so much for coming on the show today.
Thanks so much, Grace. It was great to be here. Thanks for having me.
Let me quickly